So, after the discussion on the financial statements of the commercial banks, today we will be discussing about the bank performance measures. There are many ways the performance of the bank can be measured. Some of the measures are accounting measures, some of the measures are the market measures, and some of the measures are also very subjective in nature. But today we will be starting the discussion on the accounting measures. Then in the forthcoming sessions we will be adding or we will be discussing more about the other market measures and the other subjective measures what the commercial banks have or commercial banks always use to analyze their performance in a larger sense. So, if you see that in today's discussion in this particular session, these are the major focus of this particular session is based upon these three issues. One is how the profitability and efficiency measures of commercial banks are analyzed or maybe are measured. But one thing remember, here I am referring to the accounting measures only, that already I told you, and through that we will be discussing how the different ratios or different measures are used to to calculate this aggregate performance measure of a commercial bank, or how this particular performance measure can be decomposed into the different other ratios, which is generally considered as the DuPont analysis, that we will discuss. And then we will discuss about the major factors which are affecting the bank's accounting profitability measures. Mostly again and again I am telling, we are referring to the accounting measures. So, these are the major issues what we will be discussing in today's session. So, let us see that how basically those accounting measures are analyzed or may be discussed in the commercial bank perspective. That whenever you talk about the performance of a commercial bank, performance is nothing but it refers to how adequately the bank meets the needs of its stockholders, employees, depositors and other creditors and the borrowing customers. Basically, these are the different major stakeholders of this particular bank. So, if really the bank is able to meet these requirements of all the stakeholders, then we can say that the bank is performing well. That is one perspective whenever you talk about the profit point of view. But one thing remember, the requirement of all the stakeholders are different. The requirements of all the stakeholders are different, because for example, whenever you talk about the stockholders or the equity holders, they mostly rely upon the certain measures which affect the performance of the stocks only. They may not be relying upon the interest rate charged on the loans or the interest paid on the deposits. So, this may not be a concern for them, although indirectly they are linked, but the objective of those kind of stakeholders are different than the other stakeholder of the bank. So, that is why the bank has to keep a balanced approach whenever they want to satisfy the needs or the requirements of all the stakeholders which are linked to this particular commercial bank. This is number one. And whenever you talk about the performance, particularly the accounting performance, the accounting performance are basically always evaluated for not only for the banks, for any organization or any kind of non-financial companies also. We always evaluate the performance with the help of the income statement and the balance sheet. So, these are the two different kind of or we can say that financial statements all which we use to measure the performance. That is why we have discussed a brief discussion we have made on the different items which comes under the balance sheet as well as the income statement or the profit loss account. So, this is what the performance is defined. Then how the performance is measured? Already I told you that the performance can be assessed in different ways. For example, there are certain ways the performance can be measured. The performance can be profitability measures. Performance can be also assessed through the stability measures. Performance also can be measured through the liquidity measures. The performance also can be measured through risk. Performance also can be measured through the market valuation. So, there are many ways the performance can be assessed, but again you remember in today's discussion we are only focusing on the profitability and the efficiency measures. To some efficiency measures, not all efficiency measures, some efficiency measures and the profitability measures, these are the two things will be the focus for today's discussion. So, the first one which comes to the mind whenever you talk about profitability, that is return on assets. Not only for the banks, for any organization, return on asset is the best measure of measuring the, not best measure, it is one of the important measures for the measuring the profitability. So, what do you mean by the return on asset? It is the net income upon total assets. Already in the previous class we discussed about what is how we can calculate net income, and total assets we know, which comprised of many. You have investments, you have loans, you have the other kind of assets whatever we have. Then net income upon total assets, that will give you the return on assets. General return on asset is an indicator of the managerial efficiency. What does it mean? What do you mean by the managerial efficiency? The managerial efficiency is nothing but how capable your management is to convert the asset into the earnings. The assets have been given. What are those assets? You have loan, you have investments, you have fixed assets also. There are many assets which are given to you. How basically you are utilizing those assets? Whether you are utilizing those assets in the effective way or not, that can be reflected through your net income. So, if really you are able to effectively utilize those resources, then your net income will be more. So, even if the assets are there with you, if it is not properly utilized by you, then your net income will not be maximized. So, in that case the performance goes down. So, therefore, it measures the managerial efficiency. That means, the manager is efficient enough to utilize those assets to generate the income for that particular bank for a particular period of time. So, that is why the return on asset is one of the very important measure which measures the managerial efficiency, and which is considered as the most prominent measure of the profitability in terms of accounting measures. Second one is return on equity, which is mostly focused by the equity holders. The equity holders rely more on the return on equity. The reason is, if the return on equity is more, that means the benefits of the shareholders also will be more. Whatever money they have invested, that means the equity which is invested in that particular bank, that gives them the more revenue or more kind of benefits if the return on equity will be more. Then how the return on equity is measured? It is basically again the net income divided by the total equity capital. So, it is a measure of rate of return flowing to the shareholders. Suppose to the shareholder get the benefit from this particular measure, and it basically assumes or it basically measures the net benefit that the shareholders have received from investing their capital in the financial firm like banks. So, here if the return on equity will be more, that means the performance of the equity in the market of that particular company is more. That means the equities are properly invested. Because equities are properly invested, the net income has increased. If the net income has increased, then obviously your return on equity also will increase. So, that is what the basic theme of the understanding of the return on equity. Then we have some other measures. We have the net interest margin. Already we know that what is net interest income. Net interest income is your interest income minus interest expenses. If you divide it with respect to the total assets, then we can get the net interest margin. We have net non-interest margin. The non-interest margin means what? It is the non-interest income minus non-interest expenses divided by the total assets. That will give you the net non-interest margin. Then we have net operating margin, which is nothing but the total operating revenue minus total operating expenses divided by the total assets. Total operating revenue minus total operating expenses is nothing but the operating income, which is operating income upon the total assets. And remember, these measures are basically the efficiency measures, and as well as we also consider them as a profitability measure, but mostly these measures are basically the efficiency measures. That means, how the management or the employees of this particular bank are able to keep their growth or keep their revenue growth ahead of the rising cost. So, obviously, if the expenses will be lesser than income, then there is a positive net income. If there is a interest, positive net income from the interest is positive, then net interest margin will be positive. So, like that, if the numerator in all the cases will be positive, then we can say that effectively the whatever cost the bank is incurring to manage their particular assets and liabilities, these are lesser than the revenues what they are generating out of the utilization of those particular assets. So, because of that, we can say that the positive ratios of all these indicators tells you that these particular banks are more efficient and their profitability is better. This indicate how well the management and staff have been able to keep the growth revenue ahead of a rising cost. Then what are the other things we can get from this? The net interest margin also measures how large a spread between the interest revenue and interest cost management has been able to achieve a close control over earnings assets and pursuit of the cheapest source of the funding. That means, the management is able to identify what is the cheapest source of the funding. That means, they are also able to control their earnings asset in such a way that they can maximize their revenue or the interest income, and as well as from where they are raising the money, they are also they are able to identify the appropriate sources of funding. By that, they are able to reduce their cost. So, in the end, the net interest margin becomes positive. Net non-interest margin, what basically it measures? It measures the amount of non-interest revenue which is coming out of the fees, commissions and etc. relative to the non-interest cost. There are not huge amount of non-interest cost. There are the payment to the equity holders, then you have the salaries, you have the wages, you have overhead cost, there are many costs. There is a huge amount of non-interest cost. Generally, the non-interest cost will be more than the non-interest revenue. Generally, that is why most of the banks you will find that that figure is negative. But in today's context, due to the globalization and the opportunities, growth opportunities which is existing in the market, and the development of the different financial services, development of the technology, now the fees and commissions or the other off balance sheet activities that has increased drastically. There is a this particular operations have increased by many folds. So, because of that, Nowadays also the non-interest income is increasing by the commercial banks because of complexity in the financial system. Now, there are many exotic products which are available, there are many mergers, takeovers are taking place, there are many financial instruments, complex financial instruments are available, and the banks are competent enough to provide the services to the different clients for managing these kind of assets. So, whenever they provide the services to manage this kind of assets in terms of risk management services, in terms of other consulting services, against that the income also is increasing, the fees and commissions are increasing, but still because this amount of non-interest expenses are large, maybe this particular difference is negative, but still the gap is declining over the period of time. That basically always we can observe whenever we discuss about the balance sheet. Then another measure we have, that is earning spread. What is earning spread? It is the total interest income upon the total earnings asset minus the interest expenses divided by the total interest bearing liabilities. This is a very traditional measure of measuring the efficiency, and what basically it measures? It measures the effectiveness of firm's intermediation function in terms of the borrowing and lending the money. How effectively the banks are able to utilize their lending operations and borrowing operations, that basically is judged from this particular measure, that is called the earning spread. It also shows the intensity of the competition in the market, because if there are many competitors, there are many players in the market, maybe the interest income is relatively lesser, and that is why the greater competition tends to squeeze the difference between the average asset yield and average liability cost. So, that is what basically always we observe. So, that is why the competition leads to lesser performance in terms of the profit from the organization point of view. Although it is good for the customers, because if there is a competition, then the cost is declining from the customer point of view, but from the banking point of view, if you see, the competition leads to less performance or less profitability. But still competition is a desired concept. The reason is competition becomes the system, makes the system more robust and as well as more stable, and from the customer or the client's point of view, it is also effective, it is also very effective to reduce their cost. So, the DuPont analysis is quite popular because it decomposed this ROE into the different kind of ratios. Like we know that the ROE is nothing but the ROE is net income upon total assets, net income upon total assets. Then you can write that the net income upon total assets, sorry, ROE is equal to net income upon total equity. It is the net income upon total equity. So, if you take here total assets and here the total assets by equity, then it become ROA and into total assets by total equity, and total assets by total equity is nothing but it is called the equity multiplier, equity multiplier. But if you want to expand this, you can also expand in this way. It can be written in this way: net income upon total operating revenue multiplied by the operating revenue upon the total assets, and again upon total assets by total equity capital. So, this ratio is the net profit margin, this one is asset utilization ratio, and this is basically the equity multiplier. So, now what has happened further also, although these two are quite popular, further also you can see it in the different way. You can take net income upon pre-tax net operating income, then pre-tax net operating income upon total operating revenue, then total operating revenue upon total assets and into total assets upon the total equity. So, again we have a tax management efficiency, expenses control efficiency, this one, then you have the asset management efficiency, then you have the fund management efficiency, which are basically the equity multiplier. So, how the managers are efficiently utilizing those kind of domains, those kind of items into the balance sheet, that basically gives you the idea that how this ROE of this particular bank can be maximized. So, this is the way the different components or different ways the ROE can be decomposed. But one thing is that all those ratios which are affecting this ROE, they are also determined by certain factors. Then what are those factors? Majorly whatever we have seen equity multiplier, which is nothing but the capital structure of the bank. We have the net profit margin and the asset utilization ratio, and as well as the tax. These are the 3 things or 4 things whatever we have observed, which are the responsible ratios to determine the ROE. Then what do you mean by the capital structure decision? That means how the management basically has effectively managed their composition of the sources of the funds. What sources of the funding should be used? We have debt and equity, you have retained earnings. So, on the basis of the timing, on the basis of the market conditions, on the basis of the cost which are involved with respect to the different funding, how really the managers are good enough to utilize their ability to choose an effective fund which can minimize the cost. The basic objective is to reduce the cost of capital. So, how the cost of capital can be minimized, that depends upon the composition of debt and equity. If the composition of debt and equity is changed, then the cost of capital also changed. So, what source of funding is really effective to minimize this cost, that is basically important. And the decision about dividend payments, whether a dividend should be paid or should not be paid, that is also again a managerial decision. And as well as if at all it is paid, then in what form it will be paid, whether the cash dividend will be paid or the stock dividend will be paid. So, dividend decision also will have the impact on the cost of this particular bank, which effectively affecting this ROE. Then we have net profit margin and asset utilization ratio. Then here also the managers have strong role, how effectively they decide about the mix of the funds raised and how they are invested, where the money comes and how the money is utilized. That is also very important from the managerial point of view. Size of the bank, because already we know that size has a strong role in terms of the use of the assets, in terms of the, we can say that availability of the resources in the market and all that varies across the size. So, because of that, size of the bank plays a significant role on the net profit margin and asset utilization. How the managers are able to control the operating expenses, whether really it is good enough for them to control their operating expenses in an effective manner, that also we have to always is a common factor for them. Pricing of the services, whatever services they provide and whatever services they get, whether whatever pricing they are deciding or whatever prices they are paying, whether really that price is the optimal price or not, whether it is cost effective or not, that is also the another factor. And how effectively they have invested the fund or they have raised the funds from the market, by that the tax liability can be minimized. How to choose those instruments? What are those instruments which should be there in the balance sheet or should be chosen for the investment, by that the tax can be minimized. So, these are the different factors what the managers always consider, or managers effectiveness can be measured through these factors whenever we decide the return on equity or we calculate the return on equity, because return on equity depends upon equity multiplier, asset utilization, profit margin. But profit margin, asset utilization and equity multiplier, these are determined by these factors. So, end of the day, so if you are looking after these factors, then obviously your return on equity can be maximized. Then overall, if you see, there are certain factors. If somebody wants to really see that what real factors which are affecting the accounting profitability of the banks or the overall profitability of the banks, there are many factors we can discuss, we can analyze. One is size of the banks. You know, we have a hypothesis called too big to fail hypothesis. Large banks never fail in so easily. But if the large banks fail, there is a greatest damage to the financial system. But another thing is, size of the bank is also related to information asymmetry, because sometimes people argue that there is more information asymmetry with respect to small banks than the large banks, it can be vice versa. So, that is why there is a relationship between the size and the cost what the banks incur in terms of the investments and as well as providing the loans. So, that is why size has a direct or indirect impact on the profitability. Capital ratio. Capital ratio measures the stability of the banking, basically equity multiplier. If it is stable, equity multiplier or capital upon total assets, capital means we are referring both debt and equity, that basically shows that how the banks is stable. More the stability, better will be the performance. But it can be also argued, if more equity capital will be there and sometimes the cost will be more, because of that sometimes it will have some lesser, it will have an adverse impact on the profitability. But the stability has a positive impact on the profitability, that is what we can assume. Risk. Risk means it can be credit risk, it can be market risk, it can be liquidity risk, etc., etc. So, if risk is more, then maybe the profitability gets hampered, the profitability may be less. Funding cost. What do you mean by the funding cost? The funding cost means whenever the company or the bank has raised the revenue, from where they have raised the revenue. Obviously, from the call money market, from the Reserve Bank of India or any other central bank, or there are other funding agencies. Then how these interest rates are paid? How much interest rate they have paid? Whether the whatever payment they have made, whether really it is compensating the revenue or the or really the revenue what they are generating, or the revenue they are generating it is more than that particular cost or not. So, the funding cost is higher, then obviously it will have an adverse impact on profitability. So, we can expect one inverse relationship between them. Revenue diversification. Here I have given the name revenue diversification, which is nothing but the revenue generated, what is the percentage of the revenue through the non-interest income activities. How the whether the bank is able to generate more revenue through the activities which is not related to the assets which are interest bearing assets. If really revenue is really diversified, then any fluctuations or any changes in the market will have lesser impact on the total performance of the revenue side of the balance sheet. But if the bank is concentrating on one type of assets for generating revenue, then there is a possibility of the failure. So, the revenue diversification is also quite important, whether really this revenue generation of the banks are diversified or not. Then age of the bank, more the experience, sometimes the banks can utilize their experience, use their reputation to get the funds in cheaper way, but reverse is that across the age sometimes the banks follows a very conservative approach, they may not be compatible to the technology, because of that sometimes the profit may be hampered by that. Corporate governance means the structure of the board, the audit characteristics, these are should be, that means this everything should be transparent, by that people have the or the clients have the more confidence on the bank, by that the profitability can be enhanced. The industry structure means whether the banking industry follows a monopolistic structure or monopoly structure or competitive structure. So, if it is a competitive structure, profit will be relatively averaged out. If it is a monopoly structure, then obviously there is a chance of high profit, and if the monopolistic, then profit will be in between. between monopoly and the perfectly competitive structure. That is why, and in that economy what kind of banking structure is operating, that is important. Business cycle means the economic conditions. If the conditions will be better, then obviously the banks will be able to utilize these opportunities which are available in the economy, and because of that, and the lending activities will be more, then as well as the investment activities also will be more, and which can enhance their profit through the revenue maximization. That is why the good economic condition has a positive impact. It can be measured through real growth rate of GDP, or it can be measured through the different other measures like term spread, default spread, and all kind of indicators. So, these are the tentative factors which are affecting the accounting profitability of the commercial banks. So, in the conclusion, or if you summarize this discussion, whatever we have made today, that return on asset, return on equity, net interest margin, net operating margin are the major profitability measures of the commercial banks. Capital structure, dividend policy, pricing of the services, tax liability, these are the major factors affecting the components of ROE. Bank size, risk, capital ratio, funding cost, revenue diversification, corporate governance, industry structure, macroeconomic condition, these are the major determinants which affect the, or which determine the profitability of the commercial banks. And overall, all these things whatever we have discussed, these are specific to the accounting measures of the profitability of the commercial bank. And further we will be discussing about the market measures and the other measures which are used for measuring the performance. These are the references what you can go through. Thank you.